It is Wednesday, January 27th. This is The Street Live. I'm Katherine Ross, and this morning Jim Cramer is off, but he plans to be back tomorrow. So Jeff Mark, Senior Portfolio Analyst with Action Alerts Plus, has some big shoes to fill this morning. All right, Jeff, I want to start by asking you about the markets, but before we dive into what you and the Action Alerts Plus portfolio are watching, I do want to take a moment to recognize the moves we're seeing in GameStop, AMC, and BlackBerry this morning. We've got AMC up to about $16 a share. It's up about 232% right now. We've got GameStop. I'm waiting for there we go. GameStop up to $277 a share. I don't think I could have ever foreseen me saying this out loud. It's up about 87% this morning. And then finally, we have BlackBerry up about 12% to $21 a share. Jeff, you're a fellow millennial, and I know that that's going to make you blush a little bit, but what are you watching in this market?
Well, I mean, as you accurately called out, these moves are nothing but extraordinary. Just some of the action that we're seeing in all these short squeezes. Basically, if there's a stock that is with a heavy short interest right now, I think those shorts they're rushing to cover right now because they're fearing their position to be the next raid. That would be the next raid. I don't know, but I guess the markets in general right now, we obviously saw a lot of selling pressure earlier this morning. I am wondering if this is because of those shorts who are rushing to cover, who are incurring heavy losses from their short positions, if they're forced liquidations. I do wonder if that might be a theme that we see for the next couple of days, as long as these short squeezes continue to happen at these extraordinary rates that they are, because that could mean some forced selling, some forced pressure in the S&P 500. I mean, if you look back at recent history, look at Tilray back in 2018 or Beyond Meat in 2019. Both of those kind of had some similar type of short squeeze type activity. And then right after they peaked and then crashed, it led to short-term tops in the market. So I think that there might be some concern with that. But the way I would approach this volatility, I don't think you should fear the panic. I think you should approach it with a more opportunistic lens, because I think what you're going to see is that some of these shorts, as they force some of these sells on, you're going to see some real crazy action in a lot of individual stocks. And you might see some, just I'll call them blow-ups, so to speak, where a stock is down 5, 6, 7% on no news whatsoever. And I think as long as it's a high-quality company, who's doing the right things, great management team, a market share gainer in their industry, strong free cash flow, I think that you would want to treat that as an opportunity to pick up some shares, because I still think longer term, I think the market is poised higher. We're going to get some vaccine data from J&J pretty soon, and that could be positive as well. So while there might be a lot of room for near-term volatility, I would approach it opportunistically and look to buy, not all at once, but I would look to buy into that weakness.
All right, so Jeff, we did have a bit of an earnings bonanza last night. I want to start by talking about Microsoft. Now, just based on the stock price, GameStop actually does trade higher than Microsoft. Just stock price, because I know that people are in the comments are going to come for me for that. But it is trading around $239 a share right now, up about almost 3%. We got earnings last night. What did the Microsoft earnings tell us to expect from maybe Alphabet and Facebook?
So I don't think there's too much of a comparison. They are quite different companies. Now, I think what some might point out is that LinkedIn had really strong revenues, and that really bodes well from an online advertising perspective, and that's going to be the bread and butter of Alphabet and Facebook. But what I'm really focusing more on Microsoft is really what they had to say about the cloud and the digital transformations that are going on. Azure absolutely knocked it out of the park. 50% revenue growth year over year, 48% on a constant currency basis. That's actually an acceleration from the prior quarter, so it's really great to see that business accelerate. And I think some of the bar into the print was low 40% revenue growth. So I think an acceleration in Azure is just terrific for that bull story. More specific, though, with Alphabet and Facebook that are set to report soon. Look, I think with Alphabet, just touching more again on the cloud, I think people are going to look for some of the disclosures that they're expected to put out for cloud. That's really going to help the company sort of achieve this sum of the parts valuation that is greater than the whole of what it currently trades at. And I think with Alphabet as well, they have a really strong opportunity for advertising revenues to really bounce back strong this year as we see travel spending really pick up again. That's the large source of their profit dollars. And then with Facebook, I think there's going to be a lot of conversation around what some of the new privacy rollout features from Apple and their new iOS. I think that's going to be part of the conversation as what it means to their numbers for the next couple of quarters. But I think if we do see any weakness or hesitation into that, I think that could actually be an opportunity as well to pick up some shares, because I think that I think the company is set to do really well long term. I think online advertising is the place to be. When you see a company like Budweiser, who says they're not even going to advertise in the Super Bowl this year, which is the Super Bowl is one of the biggest events of the year, especially for television. I think that shows that they might actually reach the audience better by going through online videos. And I think that's exactly where Facebook comes into play.
So another earnings report that we got was from Starbucks. They did post a bit of a slump in sales, and then the stock was under pressure after it was announced that Ross Brewer was leaving the company to actually head up Walgreens. I'm wondering, in your eyes and in the portfolio's eyes, if this is an opportunity to buy the dip here.
Yeah, so I think shares, the last time I checked, they were trading slightly below $100. So we own this one for Action Alerts Plus. We actually have a couple of sales north of 100. I do think longer term the company is poised to really exit the pandemic in an even stronger position than where they entered it. And there's some evidence of the quarter that prove that. I mean, if you look at what their rewards program is showing, their user base in the United States is actually higher than where it was pre-pandemic, and China continues to grow as well, as the adoption of mobile ordering has just been such a hit for them. And we actually saw China comps return to growth as well in the quarter. I think I would look for a little bit more of a pullback though near term, because I still think that there could be some volatility in the near term. You might see the stock react a bit to what happens next with COVID case counts. But again, I would look for a pullback, maybe more in the mid-90s range. I think that could be a good entry point, because longer term, again, as I said, I think this company is positioned very well in its future. They're going to gain a lot of market share, whether it be through new store openings, which they're adding new stores after new stores quarter after quarter. And you're also going to have, there's been a lot of closures from some of these more boutique coffee shops as well, who just couldn't last it during the pandemic and were forced to close. So I think it's a market share story. I think it's a continued comp strength story as well in China, where they recently also raised their longer term comp forecast as well at their investor day last month. So I do think this is a buying the dip opportunity, but I would wait for a couple more points.
And Jeff, I got to say, you're right on the money. It's trading down 6% to about $98 a share right now. And I also, before we move on to AMD, wanted to add that I really liked your point about the boutique coffee shops. I mean, we are seeing this pain on Main Street right now, but it is certainly could be considered a win for a big Wall Street giant like Starbucks. So with that, Jeff, I want to move on to AMD. They gave an upbeat sales forecast, which did show strong demand for the chips. How much of a threat does AMD really pose to Intel?
Well, I think it's a serious threat, and we've seen this quarter after quarter, really for the past year. AMD, their new products in the 7 nanometer are selling exceptionally well, and Intel, they just missed the 7 nanometer boat as a whole. So I think you're obviously seeing market share shift to AMD's products from Intel. But look, this AMD quarter, I know the stock's being hit pretty hard right now. It is trading back to the levels, I think in the upper 80s right now. That's sort of where it bottomed out over the past week or so after it got hit, when Intel did announce their new CEO hire. But I really like this quarter still. I know there was some nitpicking around gross margins. I really think that's just a product of the mix of what they're selling right now, because their console business, remember, they have the chips that go into the new PlayStation and the new Xboxes. That's a lower margin business, so that's going to drag down the total company's margins as sales become a larger percent of the total company's revenues. And then I would also keep in mind, too, that the company is expected to close the Xilinx acquisition later this year. I think that's a really great deal for them. Xilinx is a higher margin business, and it diversifies their exposure as well into new areas such as 5G, and it's going to accelerate their data center business, AMD's data center business as well. So I know it is back. We recently bought for the charitable trust over at Action Alerts Plus. We bought back at this level, upper 80s, but I think we're getting interested in buying it again right here, because I think the longer term story is still very much intact. And I think with these semiconductor companies, as long as that longer term story, that longer term narrative, that secular theme is intact, then it's more of an opportunity to buy into weakness than to sell into weakness.
All right, and Jeff, before we move on to our Action Alerts Plus members only show over on actionalertsplus.com, I do want to take this opportunity to ask about Boeing. Now, this was interesting. It's a posted net loss of $11.9 billion for 2020. Let's be frank, that's quite a loss for a company to announce. So how long is it really going to take for this stock to get back on its feet?
Yeah, I think that's a great question. I think that's the question that a lot of people have, just due to the overall uncertainty right now facing airlines, facing just the recovery in air traffic. But I will say, so we actually sent out a trade alert earlier this morning as the stock was getting hammered shortly after it started shortly after trading began. And we thought this sell-off was going to be an opportunity to buy. I know the conference call is going on right now, so I think there's going to be more details about the quarter that is going to come out. But I wouldn't focus as much on the loss. It's really a free cash flow story right now. And what's going to drive free cash flow higher is the deliveries of the 737 MAX and more orders coming in. And if I'm just thinking about Boeing as a whole, what I would look to right now is that we're going to get J&J vaccine data soon. And if the vaccine data is good, this is going to mean we're going to see a supply glut of vaccines, hopefully, at some point this summer. And what we have right now is a consumer who has a ton of cash right now saved up throughout the pandemic. And there's a pent-up demand for travel that's really building right now, pent-up demand. So throughout the pandemic, people were looking to buy more material goods, immediate gratification. I think that's going to transition more to experiences again once people are able to go out and leave their homes. So I think that's going to be, for the airliners, they're going to have to increase capacity to meet that type of demand that is building, that to satisfy demand, they're going to have to increase their fleet size. And you're not going to do that with an older fleet. You're going to want to do that with the latest and greatest fleet. And I think that's where the 737 MAX is going to come out into play. So I do think we're going to see more orders at some point this summer as that demand for travel picks up as the pandemic, and if the pandemic ends. And what we also have right now is China, a really strong aviation market in China. So once the 737 MAX gets approved there, and you might also see a big order come in through China as well. And that also could help ease some trade tensions between the US and China by China stepping up with the big order. So we're taking a very long-term view with Boeing. I think it's one that we want to be in looking out longer term, and we're willing to sit through some of that near-term volatility, because I do think that the setup for air travel is set to improve, especially if we get more vaccines coming this summer.
All right, Jeff, thank you so much for taking the time to join us today. And as I said at the beginning of the show, Jim does plan to be back tomorrow. So with that, we are now heading over to our Action Alerts Plus daily rundown show over on actionalertsplus.com. Jeff, I want to be honest, we're going to have some fun over there. Okay, so we're going to head on over. I'm Katherine Ross, and we'll see you tomorrow.